The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on here back to the Diagnostic Trading Hour. I'm your host, Darrell Martin, and we're right here on TFN.com. Make sure you also know that you can listen to us on your mobile phone from anywhere at TFNN.mobi. Let's go ahead and check out where the markets are at right now. We got the S&P, and let's look at that. We got the S&P right now. It is up 5.5 points. We have the NASDAQ up 0.5 point at the moment. We got the Dow up 82 and the Russell up 2.8. Gold is up 27 points on the day, and it has been flying back and forth. We're going to talk a little bit about that here in a second. And copper is up about a little over 0.5%. We got silver up over 1%, and we got corn up over 1% as well. Soybeans is down basically about 10 points on the day right now. And we got oil down 57 cents. Natural gas down almost 0.5%. Euro dollar is down 17 pips. Pound dollar down 19. Aussie dollar down 26. US yen down 8. US Canadian up 12. And US franc down 3 with the dollar index. King dollar stretching on higher in the middle of everything that's going on. So you got the market up a little bit. You got the dollar down a little bit. A lot of confusion going on with a lot of the news that came out this morning, and more importantly, the news that came out last night and what's going on over in Italy. So let's go ahead and talk about that a little bit and some of the ways that you could avoid it. We talked about it yesterday, gave you a heads up on what to focus on. We went over into the Olsen scale, and through the Olsen scale, we were able to choose to go in and pick the U.S. Canadian for the FX pair to trade on this most recent announcement. I also mentioned gold because, well, anytime Bernanke talks, gold, likes to move. And gold definitely moved, and that is an understatement. Gold moved a lot. And let me see, I'll go ahead and pull a chart up right over here, put that up on the screen. We'll maximize gold right there. And you can see on that report came out at 9 a.m. Central. And you got gold literally right here, 1595, drops down 10 points. And after dropping down 10 points to the low side there, about 1587.7, 1588, and moving on up to almost 1620. So, massive move, basically about a 30-point move right there you could have taken advantage of in gold, but just a huge move. And how would you take advantage of that? I mean, it's going crazy. You got Bernanke testifying. He's talking about how bad things are, but how good things are. And he's just getting slammed by, congressman going in and asking him questions and saying, well, you started a currency war, so what do you think what would happen? And he's like, well, we didn't start a currency war. This isn't a currency war. And it was just interesting. I was watching the whole thing over on C-SPAN, and I mean, he was just getting slammed left and right. These other guys are just going after him, and he's just sitting all back, calm and collective. And he's always a little bit nervous when he talks, But you'd think a guy who has, spent $7 trillion or whatever wouldn't be that nervous. But he always comes across a little bit nervous. Sort of interesting. But anyway, so we were able to, watch that and take advantage of that. So you had a gold strangle you could have taken advantage of, or you could have done a gold straddle, either one. And let's see here. I'll see if I can pull up, if I have the charts on that. Maybe I can actually show you. Where is that strangle? There we go. All right, so right here we have the 11 o'clock expiration, and you can see how, this went from $10 up to, over $85. Not that you would need to hang on to it that long, but and obviously expired in the money there. But this was just where it was at and how it moved really fast. Took it a while. It was going down first. So what about the downside? Was there an opportunity there? And definitely you can see how gold dropped right here. You could have sold this for about $20, dropped down to a couple dollars. And there's a whole variety of gold trades. This one was one of my favorite ones right here. It's priced right around $80, dropped all the way down to 10, hopped all the way back up to 96. And imagine a stock going from 80 to 10 to 96, in the same day. and they'd be shutting it down and everything else. So this is the kind of volatility you can expect. You can take advantage of this volatility in the binary markets over using Nadex. And you don't want to bet the binary. You want to trade the binary, okay? Which means you want to have a plan. So what I like to do is I like to go in, and so if I'm buying this, I want to sell it when it hits 57, okay? Which means if I buy it, I want to sell when it hits 43, okay? So it's a very important rule for you. So you might want to write that one down. Anytime I'm buying an out-of-the-money binary, all right, I'm looking to buy it for, ideally less than $20, $25, okay? And I want to sell it for $43. Why? Well, because when a binary hits the strike, so in this case, the strike on this binary was 1590.8. When a binary hits, when the underlying market, so like gold, April contract, hits the strike of 1590.8, it's going to be worth right at $50. Okay? So add in a few bucks on each side for bid-ask spread, and now you're looking at, like 47 by 53. But, there's nothing like, and I think we've probably, if you've traded for any time, you've experienced this pain of where the market's got almost, just right to your target exit, but it missed it by a couple ticks and it drops back, and then you're trying to figure out what to do. So what I do is I go ahead and I get that issue out of the way right away, okay? I'm going to get out when it hits 43. By doing that, let's say if it only gets within like maybe a point, or a few ticks away from my target, I still get filled. All right, so that's what I'm buying. So if I'm buying at like say $10 or $20, selling at 43. What if I'm selling? Okay, well if I'm selling, I want to do it on the other side. And so I'll go in there, and let's see. Let me find one of those up here. I know I have one for selling. And yeah, right here. So sell it for 80. Like say, sell it for $80. Now remember, a binary is worth a maximum of $100. So if I sell it for 80, it can't lose above 100. That's the ceiling. Okay. So my risk is 100 minus 80, or $20 risk with an $80 maximum profit potential. And don't get all starry-eyed with that maximum profit potential. Okay. Don't be going for home runs every time. All right. You want to be consistent in your trading. And so, if I can sell for, $80 with a $20 risk, I can buy it back for, say, 57. Okay, so if I'm buying first, sell it for 43. If I'm selling for, say, 75 or higher, so basically $25 risk or less, then I want to buy it back for 57. So right when it comes down here and it hits this price, I'm out. All right, I'm not waiting. Yeah, could I have made more? One of the worst questions you can ask yourself as a trader, okay? The reason being is, and I'm not talking about cutting your profit short. I'm talking about being consistent in your trading plan, okay? Could you have made more? Yeah, there's going to be tons of trades where you could have made more. But look at this. If you would have waited because you're going for maximum profit on this trade and you sold it for 80 and it went all the way down here, you're talking like to $5, okay? So, you got huge profit. But you're like, hey, I could have made more, $5 more. And you may laugh, but people do it every single day. Pops right back up. Now it's at 96. Now you're at a loss because you wanted to make more. All right, so quit trying to make more and just try to make money, okay, consistently. And set your take profit price. The second you get into a trade, set your take profit to get out. And the way I know how to do that is I know that whether there's 20 hours till expiration or whether there's 20 minutes till expiration, a binary is going to be priced right at $50 if the underlying market's at the same strike as the binary. Okay? So it'll be always at that price. Again, give a few bucks for, bid-ask spread, and then, throw in a little bit of wiggle room there so just in case it doesn't perfectly hit your strike, and get out. And I was over on a chat room today. Somebody's talking about how they did a trade. I called out a trade. We were doing a trade. And the guy's like, hey, I got out for 48. And I said, get out at 57. He's like, I got out for 48. And some people were like, good job. Which, hey, that is great. You made more money. That's awesome. At the same time, I'm like, what happens when you hold out? You're trying, he's like, well, I'm just trying to really ride it out and make as much as I can. I'm like, hey, I totally understand that. That makes sense. But what would you have done if it went down to, say, 52, and then 3 seconds later it was all the way back up to 75, which does happen, okay? Would you have got out then? Or would you have waited? I don't know. Exactly. So you want to get out, all right? Have that target and get out of the trade. So that really is your plan. You want to take advantage of that plan and use it. And by doing that, you'll be able to have a confident plan, a confident system. When I sell at this, I buy at this. When I buy at this, I sell at this. And I can do it consistently day after day after day without trying to maximize my profit in binaries. The problem with binaries, the good thing and the bad thing about binaries is they're so volatile. That's why you could sell at 80, you could buy back at 10, you could buy another one at 10, and now you could sell it out at 90, you know? I mean, that's insane volatility in less than 1 hour. Okay? So that's great. That's a great opportunity if you use it correctly. But if you don't, you're just going to give it all away. So make sure that you have that plan, you know your exit before you get in, and have a reason for it. Okay? Not just, well, I like 48. I mean, the reason I choose 57, if I'm selling first, to buy back at 57 is, again, I know it's going to be at 50. I'm giving myself a couple bucks for bid-ask spread. I'm giving myself a couple dollars just in case it doesn't perfectly hit my target price. And you'd be amazed how well that rule works out. Okay? I did the same thing this morning. I went in and, let's see here if I can find this trade. I went in on some gold contract. Not gold. I did some of that too. But let me pull this one up over here and see if I can find in my order history. Right here, and see if I can bring it over and put it on the chart if it'll show up over there. Alright, so we got this right here, and then we can see if we can find, okay, so 20 contracts this morning, yeah. So I went in, I went short right there, and I want you to notice something, okay? I went short, I sold 20 contracts at $93.50. And I put in my take profit within like the same, but basically within a minute or less. All right? So instantly I put my take profit in on that trade. And at 57. So I sold at $93.50, buy back at 57. That makes for a very profitable trade. And I win on the S&P. And it was sort of funny because I hop in, and I'm hopping in before all the news is out. All right? So, you know, 10 o'clock, all the news is coming out. And, you know, there's some good chance it'll be positive, consumer confidence, you know, markets hitting new highs, you know, a bunch of home sales going on. But I'm like, dude, no matter what, Bernanke is about to talk. And front and center is going to come this whole, you know, Italian election and European debt crisis rearing its ugly head and the sequester. I know those things are going to be discussed during the hearing where he is testifying before Congress there. And just that stuff being chatted about is going to be very negative for the market. And you know what? I know, but of course I don't know. But I know enough to know, you know what? This is an opportunity to take advantage of. So why don't I go in and take advantage of it? If I'm wrong, I'm risking $6.50 a contract. I can't be stopped out. Okay? And so I put the trade on, and I put it on right here, and I take it off right when it hits this price level right here. Right, actually, before it hit the gap, too. So I was actually targeting the gap. And it wasn't totally a gap fill trade, but it was how I was playing the trade. Worked out great. That 57-43 rule is huge. Write that one down, use that one, and see how well it works out for you. We'll be right back after this break.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pezzamento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces. And over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
All right, well, we got the Obama indicator in full effect. Yes, he is talking. So he's going to talk about the impact on jobs in the middle-class families by the sequester. I doubt he's going to mention it was his idea that a Congress who couldn't get along pick a penalty to penalize themselves for not getting along later, because they'll probably resolve it by then. Yeah, I don't think that's going to come up. So is it a bad idea? Yes. Do we need to cut expenses? Yes. Do we need to do it this way? No. But is a big speech 3 days before going to make all the difference in the world? No. So, anyways, yeah, so he has a little stream thing there on whitehouse.gov going on. And, making his speech. You got a bunch of people in the background with their hats on, clapping, and all that fun stuff. But anyway, so we'll see what impact this has on the market. So I'm hoping not too much of an impact. But we'll watch it and check it out. So you just sort of see the markets just, they've already got excited enough off Bernanke. There's not a whole lot left to do there. Now, we're talking about strangles. What about straddles? Okay. Well, what is the difference between a straddle and a strangle? Well, on Nadex, okay, or really on anything, a strangle really is when you have two separate strikes. All right. So if you have a strike at one place, like lower, and a strike higher, then that could be considered a strangle. And depending on how you want to define the risk reward and everything else in it, you could also call it a condor or, a butterfly. There's a lot of different ways you could define the strategy. But to make it simple, we just call it a strangle. And that's, say, you're buying, say, a strike up here, and you're selling, maybe a strike. So, like, let's say if you bought, like, a strike right here, and you sold a strike right here, and you're saying it's going to go either above this or below this, or at least to the line, okay? That's a strangle. One of the trades I called out yesterday was over on the USD CAD. I said, hey, this is the currency pair to watch out for. I was like, in addition to trading gold, the currency pair you want to be looking out for today was going to be the U.S. Canadian dollar. And talked about doing a strangle or a straddle on that one as well. And so the reason I knew that is we went over and we looked at the Olsen scale. We saw, okay, what's having the biggest impact. And, okay, so it's like U.S. Canadian, based on the reports that are coming out at this time, have the largest impact. And that's how we narrowed it down. So we knew what to trade, U.S. Canadian, when to trade it right before 10 a.m. We knew what our strategy was. Don't pick a direction. Just pick to be, both. All right? And then we had to pick our strikes. So how are we going to do that? Well, where's our take profit goal going to be? Well, inside of the members area here, we have the deviation levels. So we scroll on down to U.S. Canadian. And right here, we can see the U.S. Canadian. So we just go, okay, well, what price is it right before all this news comes out? Okay, so if we look at this, we can see basically the close there 1.0257. So go in 1.0257. Okay, so basically it's at yesterday's settlement, so that makes it really easy. And then what we're going to do is we're going to go up and down a deviation. All right? So we go over here, and you can go a full deviation, you can go a partial deviation, just however you want to look at it, depending upon the risk-reward you can put on. So one of the, let me see the strike that I bought. I think I have that one over here. And I can pull it up. We can talk about that specific strike that I bought and what the actual risk was on the trade. So we're not just talking theory, but talking, practical reality, trades being, placed. And so let's see here. I went on the US 500 and contracts bought on the US Canadian. Let's see here. We went in and got pretty decent ones. One more second. I want to make sure I get the right one for you. Okay, 1.0277. I was able to get inside a 0.7 deviation level. I was able to buy it for a price of $9. Okay, so 1.0277 is the strike that I bought. About 10 contracts. And you can see that, right there. So 10 contracts bought at $9. Order filled. Okay? And so on that trade, if I go over to 1.277, all right, this is basically how far I was saying it was going to go, at least this far. All right, on the upside. And then now on the downside would be if I'm picking, both directions. And what I'll do is get rid of all those. There we go. Make it nice and clean. So 1.0277, that was the strike I was buying, which is, like I said, well within our deviation levels. And then on the sell side, I looked at 1.0237 and 1.0247. So I actually did like half and a half, basically to give me a risk reward of $10. So we'll just put it like right there in the middle of that right there, at that price. And the price again is right here. So it's right in the middle. And so what we'll talk about, how that trade worked out and how we placed it and what we did to take profit on it right when we come back from this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the Nasdaq 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the market, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insights subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, on back here to the U.S. Canadian Strangle that I talked about yesterday on the show, which to go in, and that was the currency pair to pick. And just a reminder for you, recap, you may want to go back and look at the show. You can look at the archives over there on TFNN. But if you go to olsonscale.com, and what you do is, you can go to the last 24 hours, and you can look at everything, but you can actually get really specific. You can go, okay, well, when was the last time this report came out? So that's the big thing you want to know. The last time the report came out that happened, today. And so the last time that report came out was January 25th. So we go back here, we go to January 25th. Then we go over here and we scroll down a little bit to the time. And we're going to choose 10 a.m. And you do want to make sure your time zone lines up. Okay, so right there, you can change your time zone with that little button. And what it'll show you is basically what currency pair had the biggest impact at that time of day. And so I was scrolling down, I was looking at different ones, and I noticed, 0.9 on USD CAD, 0.9 on Franc, and I ended up going over here and looking at the CAD, and I pulled that up, and I noticed that we had, Aussie CAD, USD CAD, CAD Yen, having a lot of volatility at this time last time the new home sales and consumer confidence report came out. And when you understand that, when you know that's going on, then you can, like I said, use that to your advantage. And so, again, you want to make sure you get as much, things lining up, being consistent as possible. And now there are several reports that came out. So there's consumer confidence, new home sales, all that stuff. Obviously, new home sales being a bigger indicator because it's not just a survey, but it's actually, true, GDP, something that actually affects the market. And so you can go back, you could look at January 25th, December 27th, November 28th, and we went in and I pulled out each one of these different different times, and to see, was there a clear, you could say winner among the different times. And so we went in We pulled them up. We saw, okay, USD CAD 0.8. We had a USD Yen. That was 1. Euro USD, that was 1.4. That's pretty good. And I went over here and I started looking at all of them. I'm like, okay, let's see, USD CAD 0.5, Aussie USD Yen really low that time. And I'm not just looking for one that's high. I'm looking for one that's consistently in the top. So USD CAD, that one was a high one, compared to all the others. And, 0.7, that's a high one compared to all the others. So there's only like one time where it was sort of lower than a couple other pairs. And Aussie dollar, though it was 1.0, notice it was 0.6, 0.5, 0.3, So Aussie dollar itself wasn't really the best one, but the USD CAD over and over again proved itself to be, one of the best pairs to trade during this time when this announcement comes out. And so knowing that, that's how I know what pair I want to trade. I know what announcement's coming out. I know it's a high-impact announcement. I know what pair has the biggest quake, okay, the biggest impact on that, and therefore I can focus down, and then I go, okay, you know what? I don't know what's going to happen. So instead of being directional, I'm going to go both directions. I'm either going to do a spread or I'm going to do a strangle, a spread straddle or a binary strangle. And so I went in and I bought this one. I sold this one. I risked about $10 on each side, a little bit less than that on some of them. And then I got out when it hit 57. So basically my risk on the trade was $20. Okay, so I bought one for 10. I sold one for 90 average. And then I got out, like I said, when it hit 57. So if I risked 20, and on the upside, I actually got out when it hit 43. On the downside, I would have got out of 57. It didn't go back down. But when it went up to 43, I got out. So I made $23 on a $20 risk trade. Makes for a very good trade. And a very simple trade. Now, could I have made more? Yes. This is not about could I have made more. This is in a matter of minutes, okay, 15 minutes, I made 100% return on my investment. I don't need to worry about could I have made more. If I can do that over and over and over again, and you've seen us call these calls out telling you over and over and over again, then I can actually grow in my trading. I can start to have a consistent plan. It doesn't mean it's always going to work out for you, but it's a low-risk trade where you don't have to be right about direction. You do know what's going to move and when it's going to move, and so it lets you be very focused, and you don't have to spend a lot of time doing it. So it's one of my favorite strategies out there to trade. And it looks like we got a caller right now. We got Richard from Mount Vernon, New York. How you doing?
Hey, Darrell. Thank you so much for your help. Just an inquiry in terms of like real-time quotes for foreign markets like the DAX and German because they open earlier, and maybe even the Japan market because it seems like Thinkorswim they don't offer that, or do they? Do you know the symbols?
For Thinkorswim, they don't offer. I think they do have the. They may have the CMEs Nikkei, but it's not the actual Singapore index Nikkei.
Right.
As far as real-time markets, depends on what platform you're using. I like to use NinjaTrader. I use it all the time. And you can get pretty much anything plugged into it that you want for any market in the world. So
that's somewhat accurate. It's the same, essentially the same as the routers for the foreign markets. And is it real-time?
Yes. Well, the platform itself is free. If you're going to trade through it, then you pay. But, I mean, you can use it for charting and everything else. And then you can use, like I use kinetic.com. So and they have all the data on there. Now, that's not going to be free. But, you don't have to get all the data. They have the CME group waivers and everything else that you can take advantage of. But they have, like, every market in the world you can plug into, and it's true tick data. And it's very fast data. So you can go in here, and if I go to, like, purchase, I mean, like I said, they have all the stuff on there. But you can go in, and they have all the major exchanges. So you can go in and you can get Singapore index. Now I have a broker I use that gives me a lot of this data for free anyway. I don't know if we're supposed to call out brokers on the air or not, but if you want to email me, I'll definitely let you know who I use. And they give me about $500 of free data a month for free with a funded account of like $500. So
okay, two more questions if I could. Yeah. In terms of like right before you place trades, do you discuss that in the Tiger's Den, or do you have like a Twitter account, like you say this is the trade you're looking at, or is that something you would consider doing?
Yeah, we're looking at doing something like that over at TFNN right now. So I don't always place them in there yet, but we are looking at a way to do sort of a signal service at TFNN. So where I talk about the different trades I do. The big thing is I just talk about which ones. Like yesterday, I talked about the U.S. Canadian. I'm like, hey, this would be either gold or Canadian or both. And I said, just go in and strangle it and do it a deviation above and below. And I mean, that was the trade today that I did, that you could have done too. So I try to give you, some actionable items you can take into the next day. So that way it's not just me talking about where the markets have been, but where they're going.
Well, the problem is I tried that several times, a general idea of what you're talking about. It seems like I'm losing money every time I do it because I'm using the wrong strike or the wrong expiration or somehow.
Are you using the deviations?
I am using deviations, yes, but I'm not from you. But it's,
use ours. So they're accurate. It's insane how accurate they are. And, I mean, they pay for themselves in one trade. So
okay. Could you go to the Nasdaq trade that you did yesterday? What were your signals to go short when you discussed the Nasdaq short yesterday?
Well, I went short on the US 500, but I actually used the Nasdaq to trigger it. I had two things. That one was a little bit different trade. That wasn't my normal trade, but the Russell was pulling back in the morning. Okay, it was basically leading all the indices early in the morning here. Let me see if I get a little more data on here. There we go. In the morning, the Russell was just like it was heading straight down yesterday. And if I went back and I pulled up, NASDAQ, it was taking its time. And so I'm like, okay, well, we have the Russell like leading the pack, but we have the NASDAQ holding everything up. And so what I was waiting for, actually I was going to go short because I didn't want to get in the Russell because it was already moving. So I wanted to use one of the other indices. And so I actually used the US 500, but I waited for the NASDAQ to break. So since the Russell was always already pushing down, I was waiting for the NASDAQ to actually break down. And when it broke down, that's when I actually hopped in because there was just a great risk-reward trade over on the US 500. I mean, it was like a $6, $7 risk trade. Did 20 contracts on it, made quite a bit. And, so when that broke, this one broke, and I went in and I bought the strike. Now, this one was just, I played the gap. So it wasn't necessarily a gap fill trade. It wasn't really the intentional trade. It was just, I targeted that. And it was very small. I mean, I wasn't going for a big, the market crashed like crazy. But, in a matter of, 30, 40 minutes here, captured 600% or something like that on that trade.
I apologize. Could you be a little bit more specific when you say this one and here? Which are you talking about a specific trade today, or is that the trade yesterday?
The trade from yesterday, yeah. So I went in on the trade, and when I went short on it, I picked the binary from the settlement price of yesterday. So I was targeting the settlement like you do on a gap fill, so where the market, like right here, we have a gap from yesterday. The market opened, at a different price than the market closed as far as the pit hours. And so that's considered a gap fill. Now, that's not my usual gap fill trade because I have several other things that have to line up too. But whenever I saw the Russell heading down, the NASDAQ was pausing. NASDAQ wasn't running up. It was just pausing. And I'm like, okay, when the NASDAQ breaks, I think it's going to bring everything else with it. And it did. And everything else fell on down. I mean, it just fell down all day long. I was pretty much done for a good chunk of my day right here. But, you make that kind of return in the morning, you don't really care about the rest of the day. And then over here, I had the same thing this morning. Now, this morning I went short. I went short because Bernanke was going to hop on. And after everything that happened yesterday, and with all the, Italy stuff going out and the sequester stuff coming up, and then him getting grilled on it in the middle of everything, I'm like, it's going to pull the market back at least down to its settlement price of yesterday. And so I basically went in, I did the same thing. And I don't do this every day. It's just the last 2 days I've done this because it's lined up really well. And so I went and I chose the binary strike of the settlement price of the day. And you get the settlement price off our page or off CME's website, whatever. We post the settlements right here. So 1487.2. And so I chose my strike based on the settlement price. I was targeting that. And that's where I got out when it hit that price. I bought back at 57.
Okay, in terms when you say break, the market fluctuates up and down, but could you be more specific in defining a break? Did it go below a deviation level, or please be more specific on what you define as a break?
Okay, you talking about today's trade or yesterday's trade?
Well, actually both. Because you're using the same rules for both.
Well, my rules for today was simply Bernanke was about to talk, so I'm going to go short.
Well, be more specific about that, because when he started opening his mouth this morning, the market spiked up because he said it was more beneficial. Yeah, well, his first statement on Bloomberg was that he said it's more beneficial to consider the easing than the negative effects of the easing, and the market spiked up.
And that's why I love trading on Nadex, because I can't get spiked out while those little spikes happen.
Well, I know. How would you know the market wouldn't continue on a slow grind up? Once he starts...
I don't. I have a $7 risk, though, so it's okay. So, I mean, you never know. Any trade you hit, you never know. There's no, except for arbitrage, true, pure arbitrage, you never know. So the thing is, can you put probability from experience in your favor? Can you put risk management in your favor? Can you not be stopped out? And I have a $7 risk. I'm buying back. I'm going to make 300, 400, 500% return on the trade if I'm right. I can be wrong a lot and still be break even. So it's the risk reward is in my favor. The probability is in my favor. Just knowing what happens when he opens his mouth is in my favor. So, and yeah, I mean, he opened up. I didn't wait till he started talking. I got in before he started talking, because what happened yesterday is the European whole crisis came into full focus because Italy is going to become the next Spain. I mean, that's just what's the word on the street, whatever. And then the sequester is right around the corner. You know he's going to get drilled about those two things, and there's no positive way to spin it. And so the more he got drilled on the debt and the country, I mean, they're going, well, what's the real debt? I mean, you're listening, obviously. So they're like, what's our actual debt level? And he didn't really even want to give an answer. They finally got him to say, well, is it at least greater than 16 trillion? And he's like, well, yes. And so those hard questions are coming in. That's going to be seen as negative. Now, I don't have an outlook for the rest of the day. I just want to get in. I want to get out when it fills the gap. So I'm going in for a very small move and trying to take a profit. I'm not trying to get a home run. Now, I mean, the return on the trade was definitely a home run, but I'm just like, hey, if it gets here, I'm happy. I don't care if it drops another 20 points for the day. If it gets there, I'm happy. And I could easily see it pulling back at least to fill that gap while he's talking on the negative news. Because, again, you have all those orders from overnight on the stock market that haven't been filled yet. All those, those 500 stocks. There's all these limits just sitting here that have yet to get filled. And so it goes through and it starts triggering all of them. And, I mean, that's what makes a gap fill. And so, again, that's not my pure gap fill trade, but, it works the same way. And so that's just one of the ways. Now, the other ways I always, like on the Canadian, I actually targeted the deviations. So I went in and go, okay, what's the low risk, high reward, or at least 1-to-1 reward? And I do a lot of 1-to-1 reward trades. So I'm okay with that. If I can be profitable 70% of the time, then that's awesome. 1-to-1 is great. And so, but you have to have a strike you're picking, and it can't be subjective. It needs to be very objective. Like, it needs to be a settlement price or a statistically based deviation level. Not when this line crosses that line price. You can do it that way, but for consistency, I need one consistent way to help me pick a strike. And that's what I use. I use the deviations over and over again because it's implied volatility. It changes every day. I mean, today we're at 16.9 for, the implied volatility levels on the S&P. Yesterday I think we were at like 14. The day before that we were at 13. So it changes every day with the implied volatility in the market. But we can come back and talk more specifically about what I mean by a break for yesterday. Okay. Basically, I just been a broken support, but we'll go into that. Stay right there. We'll be right back.
Okay.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, welcome on back here to the Diagnostic Trading Hour. We got Richard on the line. You there, Richard?
Yeah, Darrell, I was just finding it interesting. You were fading Mr. Ben Bernanke, but how do you see the sequester going forward? It seems like every time they're playing with the markets, they seem to like to have these announcements on Monday morning at 9:55 that they're buying.
Right. This one's a little bit different because it's not like the actual debt ceiling, where the whole government shuts down just because they don't pass something. So there's a big difference between this and the debt ceiling. Now, we still have the debt ceiling that's not completely resolved. It'll rear its head here again in the next, 60 days or whatever. But I think it's going to happen. I think they may try to scramble to see how bad is it for them politically to see how much they have to act afterwards. Because just because the sequester goes into effect on Monday morning doesn't mean people get laid off on Monday morning. At least not 20,000 people instantly. So there is a little bit of time to act. And I think this is more than anything, my personal opinion, this is pure politics. And it's about who can gain control of, of Congress in the 2-year session. And I think Obama's play is let it go through, act like we don't want it, and blame the Republicans and gain control of the House and keep control of the Senate. I think the Republicans are thinking, if we don't stick to our guns on this, we already gave in to tax increases, then why would we be reelected anyway? So they're sort of in a, not good if you do, not good if you don't type thing. And I mean, the reality is we need to cut. I mean, not with a hacksaw like they're doing on this. But I wouldn't be surprised if this one went through, if this actually did happen. So, because everybody agreed to it, they signed it in, and the Republicans aren't going to give in on more taxes after already being taxed, and the Democrats would much rather use this as a weapon going into the next election cycle. So I think the two sides are just vehemently opposed.
That's a long time away. I mean, it's very seldom they say that the voters don't remember, from 18 months or beyond, just a couple weeks for something that's substantial. But in terms of the market, I mean, forget
right. But this doesn't go on for one day. This goes on for every month. They're going to be cutting money out of the market. They're going to be laying people off every month. People are going to be on furlough. They're going to be going to work 3 or 4 days a week, not 5 days a week. So this isn't like it happens once and goes away. This is every day happening to tons of people throughout the country. So they're going to remember it. It isn't going because they're going to remember it on every single paycheck.
But what percentage of people are actually affected? I mean, it's less than 1% are actually affected.
Yeah, 1% gets a lot done, though.
but how do you perceive the markets are going to react to this nonsense?
I think they'll see it. I mean, everybody already knows GDP should decline. This is going to further add to that because less spending does mean decline in GDP because obviously none of the QE has anything to do with GDP because it's not going to the money supply, which won't help unemployment, all that. I see it could sell off, but I mean, honestly, I try to not have a complete long-term opinion on what direction the market is going to go based upon, especially government news. I just try to trade the day. So, what's happening that day, what's coming up that day, and how can I take advantage of it? So, yesterday I'm like, hey, Italy stuff's not going that well. It's probably going down. Okay, we got a setup. The Russell's going down. The Nasdaq's hesitating. And so when I said break, all I meant was I was just literally looking. Let me pull this up right here. On the Nasdaq, I was just waiting for it to break the low from early in the morning. As soon as it broke that, I'm like, we're ready to go. Let's go. So I was just waiting for it to finally break that low. That was it.
Okay, Darrell, thanks very much.
Hey, you bet.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.